So let's come back to the Nigerian equities market, which has been raking up some decent gains since February started. Despite the news and noise around the February 25 general election, the new Naira notes program, and the decline in treasury yields. So how are investors making headway on that? The fire of politics and the pressure cook a social environment. Let's chat to Johnson Chukwu, the CEO at Career Asset Management, on this latest development as we look in towards the end of the week. Good evening, and we thank you for making this on the show tonight, sir. Let's start at, is there any sentiment in the equities and fixed income market regarding the crisis? Let's start with the new Naira notes.
Good evening, Boston, and thank you for having me. I doubt if we are having any major sentiment in the market in relation to the cash crisis. Remember that the equities market or the capital market is a market for surplus units and an economy. The law does not allow investment in the capital market with cash. So you realize that those who invest in the capital market are those who have their monies in the banks. And because of the level of automation now, all you just need is move your money to your stockbroking account, and then you can actually trade directly, or you get your stockbrokers to trade on your behalf. Once your stockbroking account is funded, you don't need cash to do your capital market investment. So the sentiment, other than the inconvenience that people are going through, particularly the people at the rung of the ladder, but in terms of impact on the capital market, I don't think we've seen any impact. Of course, the market decline today may not have been attributed to the cash crunch that we have in the economy as it relates to fiscal cash withdrawals.
Let me ask you, you talk to investors, everyone else in between. Are we seeing, or are you seeing inflow of more investment into the market in recent weeks?
You know, interestingly, the market in the recent weeks has enjoyed some major improvement in terms of votes and in terms of confidence. And principally because we're moving towards the benefit season. And we're looking at a period where the reports coming from quoted companies are quite positive. We've seen companies showing returns of 100% appreciation compared to the previous year's performance. We've seen operators in several sectors of the economy report very good results. The banking industry, we saw the FCMBs of this world, the Islamic IBTs of this world, the Fidelity Bank of this world, coming out with very strong performance. And then the telecommunications sector, we saw MT and Airtel come out with strong performance. We also seen that in other sectors of the economy, like oil and gas sector. So we saw corner year results, and these are what's activating or motivating investors to come into the market. And that's why you've seen market performance in the past couple of weeks come out very strong, because people are investing with expectation to get the benefit, to position for the benefit season.
But the elections of February 25th is just around the corner. So is it just the earnings expectations that's keeping equities on the upward trajectory so far? Is the market ignoring all the noise and news around the elections?
No, I wouldn't say the market is completely blind to the activities around the election. But somehow the market feels that the election will be largely, and I mean use the word largely, free and fair. Obviously, there's a lot more confidence in the electoral process because of the introduction of beavers. So investors are not apprehensive that the country will go up in flames or in smokes. So investors are confident that after the election, there will be business going forward. Beyond that, if you also look at the return environment, you realize that the yield of fixed income instruments have drastically declined. The last Treasury bills auction, T-bills auction came at about 2.24% for the 364-day instruments. For the 180-day instrument, it came at a 0.3% yield, and for the 91-day instrument, about 0.1% yield. And compare that to the return you get, even if all you are angling to get is your dividend return. Dividend yield in the country is an average of 5%. Then if you also consider there's a prospect of capital appreciation, you find out that the dividend yield, which should come in the next couple of weeks, is even higher than the yield you will get on your trade-based investment if you invest at 2.24%. And that's why investors are underweighting their portfolios in fixed income instruments and overweighting them in equity instruments. That's the vote you are seeing in equity instruments, largely driven by the fact that returns on short-end fixed income instruments are quite low, far below the dividend yield in the country.
Yeah, so despite all fireworks around the elections and the new Naira notes, you and your colleagues are the one who's been having some very nice time, smiling to the banks in a manner of speaking. But let's look at the raft of reports that has been released on Nigeria from the latest Article 4 report, which came out yesterday. Then we've got the market also, the economy receiving some ratings from S&P and Moodys. What's the state of what is the market listening to this macroeconomic, wider macro issues, or the market is just piping on, moving on its own, and just ignoring those external reports on the state of Nigeria's economy?
You know, interestingly, both in what we got from Moodys and what we got from S&P are what have been factored in the investment decision of local investors as well as foreign investors. So it wasn't for those of us in the market, it wasn't anything new. It was just a report. I mean, when you finish your exams, you know your report, you know how your performance is. And that's exactly what we did. We already knew the situation of the country. There was nothing they said in either the Moody's report or the S&P report that was not known to us. Of course, we know in the S&P report, they said they downgraded us to a negative outlook. I mean, if you look at those factors that they consider as high debt service, high low government revenue, high budget deficit. We all knew about these things. They were not new to us. And the factor that Moody's considered, we are about the same factors that S&P considered. So we had factored them into our pricing of instruments in the market. And that's why the market did not react to those reports. Because we knew ourselves as a country, we knew how delicate our economy is. We also knew the upside potential of this economy, and we know that if we get the election right, the country will reverse the current decline we are witnessing in several sectors of the economy. And local investors are willing to bet on Nigerian market economy. Again, we also don't have, because of the fact that our currency is still not tradable. Or convertible, we didn't have the window to go and invest outside the country. So we are limited to instruments within the country. And that's why whatever happens, we are stuck within our environment. But most importantly, we appreciate those things that they are saying. We already factored them into our investment decisions, and hearing them from the rating agency did not make any difference to us.
Interesting. Thank you so much for your time on the show tonight. As always, sir, we appreciate it. Johnson Chukwu, licensed dealer and CEO at Carry Asset Management.